Hello everybody and welcome to this lightning round video. So out of the 5 stocks that I'll talk about today, I own 4 of them, but Sezzle. Unfortunately, I really wish I did because I covered it more than 2 months ago. And anyways, winners and losers, you'll see. I'm gonna tell you my thoughts on each of these stocks. These are all stocks that I consider to have high quality, but I don't have time to do a full coverage for their earnings. So let's get started with Sezzle. Sezzle, the responsible way to pay. This is a stock that, from what I understand, has a big market share in Germany. It's one of the buy now, pay later plays. You may remember my video from March 16 for buy now, pay later play stocks. And in this video, I described Sezzle as really the least expensive one. If you compare to a firm, for example, a firm was at a 1.1. This is at a 0.27. Well, I'm pleased to say that it is still the least expensive buy now, pay later type play. It has very impressive growth. In fact, it's stunning. I mean, there's no other way. Total revenue, the revenue from Q1 24 to Q1 25 grew up 123%. You can see they have the operating leverage kicking in with their adjusted income up 286%, their net income up 250%. So the bottom line is growing at 200+%, and the top line is growing at 100+%. And you know, it almost makes you wonder why I'm so conservative using 52% forward revenue growth on Sezzle in my spreadsheet. Well, the reason is because I copied what the analysts say, but I think the analysts are way off with 52%. You may have a stock who's actually trading at a 0.15 on EV over GP over RG if you were to take a higher growth rate, say close to 100%. Do you decelerate to 50% from 123%? Revenue growth year over year? Do you decelerate the next year to 52%? That would be a precipitous drop. So I think this stock is going to continue to perform really well. Though when they reported earnings, unfortunately, it pumped like more than 30%. So I can't help but feel like I missed it. The stock over the past 52 weeks is up 932%, right? So it's roughly a 10x. This stock has done a 10x in a matter of 1 year. So again, I feel like I'm too late. Revenue grows 100% and the stock does a 10x. The valuation is growing faster than the revenue. I like my stocks to grow in line with the revenue. I.e., when a stock has 100% revenue growth, I enjoy to see a 2x in the stock price. Nonetheless, the valuation is inexpensive compared to all of the other buy now, pay later plays. And of course, the numbers are outstanding. The number of buyers are outstanding. What I want to point out, which is very rare, of course, in commerce, right, in retail, typically Q1 is typically lower growth than Q4. This is a well-accepted thing for any retail company. For a lot of companies, it's like that. Q1 is less than Q4. Look, they're actually showing sequential growth between Q4 and Q1. Very little, but they're showing sequential growth between Q4 and Q1 in a quarter Q1, which is usually much weaker than Q4, the holiday season. So this stock is nothing but green flags. The issue of this stock for me is the psychology because it's up 900%, while the revenue is only up 100%. And so I feel like the stock price is growing faster because it is getting discovered by the market. It's getting more and more popular by the US players, you know, the US buyers, and so it loses kind of that cheapness that it used to have. But I am monitoring and I am waiting for a drop. If there is a drop, I will be interested in that one. Let's talk about another stock. And this one is going to have my over infamous, I guess, you know, calling for a stock. It's boring. SMCI has been a boring stock. SMCI has become a boring stock. From March 1st to March 9, the performance is minus 11%. And you know, I say it's boring because this used to be one of the most volatile stocks, you know, in the S&P 500. You know, as short-lived as they've been included in it, it used to be one of the most volatile stocks. It used to be one of the hottest stock, and then rumors of accounting issues have kind of, you know, killed the stock, unfortunately, for traders at least. But I own SMCI. I'm actually up on this one, and I own it because the success of this stock is kind of inevitable in my view. And of course Wall Street sold the stock, but Wall Street barely sold the stock. The stock barely moved when they reduced guidance for 2025 and talked about delays, right? So this stock has delays. There's Blackwell delays, and people say the stock is down because of tariff fears potentially on Taiwan. A lot of the products they make are manufactured in Taiwan. Okay, there are delays, so Wall Street isn't happy, but Wall Street is also torn on this because they want profit now and they're unhappy, but I think Wall Street also knows that success is inevitable for this company. It's just a delay because there's really not that much capacity in liquid cooling. There's two liquid cooling giants. It's Dell and it's SuperMicro. SuperMicro is a pure play in liquid cooling. If you read about SuperMicro, research it, the CEO is all about what he calls green computing, the green computing revolution, saving the planet with liquid cooling, etc. It's the liquid cooling giant. And I think fans are not going to be a thing in data center anymore. Even AMD, if you listen to the AMD call, which I did, I guess I found time to listen to the AMD call. They actually talked on this about SMCI on the AMD call, and NVIDIA, which is of course, SuperMicro and NVIDIA are kind of friends, if not best friends. You may remember that video I made about them, where I did a deep dive between both companies are headquarters, a 9-minute drive, and both CEOs are from Taiwan, and they were born something like a 30-minute drive from each other. They're the same age. They've been in business for 30 years. It's a strong tie to NVIDIA. This company has a strong tie to NVIDIA. And guess what? NVIDIA has a clear roadmap until 2027, and it's all liquid cooled. And if you look at the roadmap that's coming, especially the Feynman version of the GPUs that comes after Blackwell, well, that's going to be another 1000x in performance. So when people put Blackwell, they're going to upgrade really, really soon in 26 and 27 to Feynman. And so that means another wave of upgrades and another wave of, probably in my view, building out more data centers that are liquid cooled, that are going to need SMCI. So they're going to need SMCI, they're going to need Dell. That's kind of the way I look at it, as a long-term hold, a long-term play. And of course, I wouldn't be in this stock if it was, expensive. But on this channel, I've called NVIDIA cheap. NVIDIA is trading at under 0.5 on this, which I find cheap for NVIDIA. Well, if I find NVIDIA cheap, think about what I think of SMCI. I think SMCI is actually dirt cheap on this. It's trading at a 0.13, but it is at the heart of the hottest sector of the market, which is AI, right? HIMSS is still slightly cheaper than SMCI at a 0.125, but HIMSS is sitting at the heart of one of the market's most hated sector, which is healthcare, which doesn't have the valuations of AI. So I can't reconcile the fact that this SMCI has essentially the same valuation as HIMSS, except HIMSS is in one of the hated sectors of the market. SMCI is in the hottest sector of the market. I think HIMSS, I don't need to see much multiple expansion on HIMSS to be a happy investor. If it keep growing at 65% and price to sales doesn't change, I'll be fine with HIMSS. But SMCI, not only are they growing at 60% a year over year, a nice clip of rate of growth, but also I expect multiple expansion. I think you could see significant multiple expansion in SMCI. I love the stock. I think it's a great stock, and I think Wall Street is slowly forgetting about the whole mess that 2024 was for them, and the sales will speak for themselves. So I'm very happy to own SMCI actually, and it's dirt cheap. There's no other way to say it. Okay, moving on to TransMedics, a stock that is not dirt cheap, a stock that is slightly expensive, I would argue. TransMedics. So let's talk about TransMedics. TransMedics, of course, they have the organ care system. So they are the disruptor of dry ice. So if you know anything about organ transplants, there's this technology that is more than 50 years old. And as is often the case in the medical field, things don't change much. So we're still most of the market is still transporting organs like we were 50 years ago on dry ice, and they invented this device. It's an FDA approved device. It's an organ care system. It allows the organ, once there's an unfortunate accident, typically a road accident, although sometimes just people pass away at the hospital, but there's an accident, and typically you send a surgeon, you collect the organ, and the organ are put into the organ care system, which is a machine that keeps the organ alive for multiple days. Then the organ gets on a plane, and the plane flies to wherever the most compatible recipient is on the list, high on the list, urgency. There's a whole national system that dictates where the organs go. And then TransMedics has a bunch of private jets that they're actually much smaller than private jets. They got into the airline business. They bought this flight school. They shut down the flight school. They kept the pilots. And what happens is they have an airline that transport the organs. And so these are very expensive procedures. These procedures cost $200,000 to $300,000 is what they cost. But nonetheless, there's tremendous benefits for TransMedics. TransMedics is winning the market, and it's for two reasons, really. It's winning the market because dry ice is highly problematic. A lot of organs don't make it. There's a lot of issues. And then it's winning the market because in the old way that this used to be done, you needed to contract out the transportation to a private jet company because unlike in movies, you can't transport an organ on a commercial airliner. You have to use a private jet. And turns out, 1 day out of 3 in the year, private jets are not available. You happen to have a sporting event, there's no such thing as a private jet available for booking. And so TransMedics has dedicated jets that are just to transport organs, that are just available. It is all they do. And that's why this company is growing quite fast. It's got a lot of optionality. It updated the guidance to the upside. Nothing to sneeze at. Like we're talking about roughly 40 million more. So they guided up between 27 to 30%, right? So that's a major increase in the guidance. When I input the numbers in my spreadsheet, like I said, it's 0.46, but they achieve a rule of 40 at a 45. So the stock is still slightly expensive, but the top line growth is there. And there is one last thing I want to say about TransMedics, of course, which is the biggest business. Let's look at here. The biggest organ that they deal with, of course, is liver. Liver is the biggest. Heart and lung is the second and third biggest, but they are talking about doing this for kidney, and so kidney could open up a whole new opportunity if they got their device approved for kidney. And of course, it's like connecting the dots, right? On this channel, for example, I cover CorMedix, which is in the kidney care category. And what happens when your kidney fails? Well, unfortunately, if your kidney fails, there's nothing we can do, and we have dialysis, etc., etc. I'm excited about them potentially doing kidney organ transplant. That could be a game changer. So just like medical opportunities, medical companies, any medical companies, they have these binary possible opportunities, and TransMedics has one of these binary possible opportunities where they could expand the organ care system to more organs. So in my view, it's a pretty solid company. I don't do a full coverage, but it's a pretty solid company. I'm not buying anymore. My position on this one is beginning to be old. I'm not buying anymore. I'm just here for the journey, just here to enjoy the ride up. I think this stock is going to do well. Note this stock has been much cheaper in the past, right? So, now it's not a sell valuation, right? It's not trading at a 1. If it was trading at a 1, I'd consider selling it. It's not a sell valuation. But I don't think it's the best entry point either. Let's talk about another company, MercadoLibre. So MercadoLibre, covered it a few times on the channel. Very little retail following, very little retail investors buy MercadoLibre. MercadoLibre shot up, what was it, 19 or 20%? Quite impressive for a company that is $122 billion in enterprise value. MercadoLibre is the Amazon of Latin America, but instead of having AWS, they have a fintech. Amazon copycats around the world. they usually have a fintech attached to them. We just, in the US, live in a weird world where Amazon doesn't have a fintech attached to it. Amazon has AWS attached to it. But it's the Amazon of Latin America. They're ahead of Amazon just about everywhere in the countries they operate: Argentina, Brazil, Mexico. Of course, this company is fairly old, so it's showing the law of large numbers kicking in, because you can see they only grew year over year 28%. I guess they accelerated a little bit the growth on items sold, but if you look on gross merchandise volume, they did 40%, they were at 56, and they were at 71. So you have the law of large number that is slightly kicking in. This is a company that I expect over the next 5 years is gonna grow. Maybe this year they're gonna do 30% top line, maybe 26, 28% top line, 27, 25% top line, and then maybe after 2030 we'll be growing at under 20% top line. It makes sense, a big company. So the large number is kicking in. Their fintech division is doing really well, asset under management growing at plus 100% a year. They have a solid fintech division. Some of their fintech division actually directly competes with another stock I own, which is called Nubank, but they have a focus more on micro transactions. They do a lot of micro transactions with small businesses that just use the Mercado Pago app to do their transactions, etc. Anyways, it's a business I don't follow too closely because it's a business that I call a sleep well at night business. It's never disappointed me, and I don't think it's about to begin, and it is still cheap at a 0.34. To me, this is a buyable stock at this level. It's still cheap. Moving on to the last stock, and this is perhaps the stock that I'm adding to the most aggressively, and that I'm so happy because, well, I guess SMCI, I find it pretty darn cheap too, but I have a bigger position in SMCI. So SMCI aside, TGTX, TG Therapeutics is the one stock that I am working on right now. I'm working on increasing my position because it's the perfect setup. Wall Street sold the stock because they did not focus on profitability enough. And they sold the stock like 26%, right, in the 3 days since they reported. And this is perfect for me because Wall Street sells the stock because they're like, oh, they only earned 3 cents of GAAP EPS, and we were expecting 17 cents of GAAP EPS, and they did 3 cents. We're expecting 17 cents. Sell, bad, sell, right? And all the articles online relay and say, hey, sell. They were supposed to do 17 cents and they did 3 cents. And me, when I look at them doing 3 cents, I'm like, hey, I'm happy. They're paying less taxes. That's great, because I look at earnings per share, especially the GAAP version. I look at this version as only an accounting metric to know how much taxes they're going to pay. I don't care about that. I care about adjusted EBITDA on this channel. And adjusted EBITDA, sure, may not be the highest either, but it's fine. And adjusted EBITDA is higher than what they reported for EPS. And frankly, what I care about the most about this company is the adoption of Briumvi. And Briumvi is getting adopted at a faster pace. Briumvi is the least expensive CD20 therapy for relapsing forms of multiple sclerosis. So it's about $50,000, $50,000 to $55,000. I can't get the exact prices, but it's about 50 grand, and the competitors are probably at 70 or 80 grand. And of course, they raised their guidance. So they raised the revenue guidance, which means that the adoption of a product is going faster than what they had guided. And you may say, oh, why do I like Briumvi here? Well, because the FDA granted essentially what I'm going to call a triopoly. There's only 3 drugs that are ever going to be approved for relapsing form of MS. And that's Briumvi is the newcomer out of those 3 drugs. And Briumvi, because it is the last drug that was approved, it is slightly better. It has an edge. It has an edge compared to the other ones. The edge of Briumvi is actually in the injection time. The injection time is much quicker for a Briumvi treatment than for, say, Ocrevus. Ocrevus is the competing, one of the bigger competing treatments. And of course, the problem is that the doctors are still most comfortable prescribing the older treatments that they're familiar with because this is the new treatment and we don't have enough of a look back. It's kind of your standard. So they have to invest in education to say, hey, look, these are the studies. They have to go to medical conferences. They have to convince more and more doctors to prescribe this one as opposed to prescribing the other one, and they have to show the benefits of the other one. And sometimes we say science advances one death at a time. right? And so in the prescription world, perhaps one retirement at a time. You get the newer doctors, the new doctors, and they don't have preconceived notions or ideas as to what is the best treatment. And then they're like, hey, I'm going to choose Briumvi. Briumvi is priced the cheapest. And so that actually also could be a big play for insurance, right? Insurance could say, hey, you know what? The doctor might have prescribed, say, Ocrevus. I'm going to override the doctor and I'm going to direct them to Briumvi because Briumvi saves my insurance company $30,000. So there's a benefit to being cheaper. They're also going after another condition that is related to MS, which is called MG, I think. I can't remember exactly, but it's called MG, which is also a disease that really, really needs a treatment. And that's the last thing I'll say. MS is an awful disease. It's when your nerves start the insulation around your nerves stop working, and so it's a very, very painful disease. And it's not like people have a choice, right? It's not like you have a choice to say, oh, I'm not going to get treated. No. Unfortunately, if someone has MS, their biggest priority in life oftentimes is to get it under control. That's why these drugs, I think, sell well, and I think they have a lot of potential. So again, ethically, I love it. It's the cheapest company. It solves a debilitating disease. Doctors don't like to use the word cure, but still, it's pretty close to it when you look at the remission rates, and it's cheap. The company is trading at a rule of 40 of 80, so twice the rule of 40. Enterprise value over gross profit over revenue growth is 0.24. So that's cheap. That's cheap. This company is very cheap. I'm very happy to own it. And forward revenue growth 65%. Okay. Growth past 52 weeks was 100%. I think this company has a lot of growth ahead of it, especially when you get a discount. I had gotten used to this stock being above $40, and now it's in the low $30, and I think this stock is quite interesting. So I like it very much. Anyways, this is a lightning round. This is a new format. I don't have time to do a deep dive on each of these, so I hope you liked it. This is not investment advice, not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful day.